The last part of this I wanted to touch base on was leases. The difference between an operating lease and a capital lease, because leases are, you have something and then you have to pay for its use. Think of you just as renting your apartment. It's not your apartment, you're leasing it. So you're constantly having to pay payments. So a normal operating lease would be like for your car or for your apartment. You're never going to own it, and it's not yours. And especially if it, now I'm not talking about making car payments. That is, you do own the car and you're making payments back to the bank. A lease would be when you lease it from the dealer for like a 3-year period and you have no intention of keeping it. So that's what a normal operating lease is, and you simply record it pretty much like you would think. You record, if you're the lessee, you're the person who's using the apartment, you just simply show that you have a rent expense and credit your cash. And it would be just the opposite if you were the landlord. You record the cash and credit rent revenue. So operating leases are the easy one. It's where we come into a capital lease, and this I need to change the term. Capital lease is a little bit different. For accounting purposes, you record capital leases like you've actually purchased the item. Because what a capital lease is, and we don't cover it in this at this level, but when you get into intermediate accounting, should you keep going in accounting, you're going to see that capital leases, you'll know it's a capital lease by either how long you will have it versus the useful life. So what I mean by that is, if you have a machine and the machine is known to really only be in good condition for 5 years, after 5 years it's out of style, it's out of date, whatever it is. And if your lease is at least 4 of those years, then when the company takes it back, or if they ever do, it's basically like you owned it because you had it for its entire life or almost all of its life. The other way that it's a capital lease is if you end up paying for almost all of it, meaning the company paid maybe $100,000 and then you're leasing it from them at $10,000 a year for 10 years, you're basically paying for the whole thing. So that would be considered a capital lease if you've either owned it for most of its life or you've paid for most of it, if not all of it, in present value payments. So when you have a capital lease, you have to treat the situation different. First, you actually record it like you bought it. You debit equipment and you credit this payable account, this liability account, this lease liability. And you're going to record it at, note here, the present value of all of your lease payments. We just talked about present value when we were talking about bonds. What is that? What are all those payments worth right now that you're making over the next 10 years, if that's how long you're paying for this lease? So you're going to use the tables to figure out what is all of those worth in 10 years. And then just like when you buy a machine, you're going to depreciate it just like it's yours. And you're going to expense out the cost of that equipment. Instead of expensing out the payments that you make, because you're not going to call it a rent expense, you're going to actually be owning it. You're going to show that it's an expense by actually using it and depreciating it, just like you would have bought it. Okay, so I got my example here. We're on the first day of the year. We have a 3-year capital lease, so I go ahead and tell you it's a capital lease. Otherwise, if it's just a normal situation and you were in day-to-day life, you would have to make that determination. Is this a capital lease or is this an operating lease? So the capital lease on our equipment, and we're making monthly payments of $100 a month for a total of $3,600. So hopefully you see where I got that. $100 a month for 12 months is $1,200. For $1,200 for 3 years is $3,600. So that's how much we're paying. Interest is 12%. The present value of the lease, So I went ahead and did the calculation for us. I wouldn't have had to, but I think the book does it for you anyway, so I went ahead and did it too. You could have figured it up by using the present value of the annuity. You could have said, okay, my interest, remember your interest, we wouldn't use 12% because we're paying every month. So it would be 12% divided by how many payments in a year? So 12 divided by 12 is 1. We're making 36 payments. Oh, this is why I did it like this. Is our charts don't have 36, it has 35. So I had to use a number close to 29, but just a little bit more because we're heading towards 40 if we're at 36. So I picked like 30.1, and that's how I got this $3,010 amount. It's close, it's probably not exact, but it's probably within 15 bucks. So now when it's a capital lease, remember I'm going to debit the equipment just like I own it for the present value, and I'm going to credit this lease liability. And we could call this anything we really wanted. This is just a very generic term that shows that, yeah, it's a liability. I'm going to need to make payments of at least $3,010 over the time. Now, you're going to say, hey, wait, I thought you had to make payments of $3,600. I did, but this is just simply the note part. This, the whole part, includes interest and note. So this is just the bare bones note. This is what I'm going to be paying with interest. So now I can start making my my payments, and to do that, going back to our last session in chapter 9, when we made this amortization table, I want to then figure up how much of my $100 payment goes to my loan, the 3,010, and how much of it is interest. So then we do I equals PRT. So I take the P, principal, 3,010, times the rate, 12%, times the time is only 1 month. So let's do that. Let's do 1 month times 12% times $3,010. I got interest of $30.10. And then if I pay 100, the first $30.10 goes to interest. That means the rest goes to the note. And if it goes to the note, then it brings down what I owe on the note by $69.90. So that's all I did to get this new number. Now let's go ahead and do it one more time, and then we'll do the journal entries. Let's figure out what payment 2 is. Payment 2, the interest, the cash is still going to be the same, 100, but the interest is going to be slightly less. Let's figure it up. We got 1 over 12 times 12% times 29.40 and 10 cents, because that's our new value of the note. So my interest is now $29.40. That little extra goes to the note. A little bit over time starts adding up. Now we can do my my journal entries. These over here are going to be my 2 debits, cash being my credit. So a lease liability, my note, the value of that note goes down by $69. The rest is interest, and full payment of $100. And then you can see what it looks like. It's the same setup, just with a couple of different numbers for my debit, my 2 debits, and then my credit stays the same at $100.